What's up, strangers? Welcome to the Wealth Game Nation. My name is Vedo, and I'm here to help you better understand the wealth game and become part of the Wealth Game Nation. In today's video, I will show you how to build an all ETF portfolio in 2023 with only $1,000. So let's get right into it. On today's agenda, we will shortly cover what are ETFs and why invest in them at all. Then we will look at some different indices and sectors. Then we will build an ETF portfolio. And then, as usual, I will share with you my thoughts. What are ETFs and why invest in them at all? ETFs, or exchange-traded funds, are baskets of securities that trade on an exchange just like any other stock. They are automated and they passively mimic an index. So you can imagine a basket full of different stocks, and by owning one share of the basket, you automatically own a small piece of every single stock that is in that basket. Now that we know that an ETF mimics an index, let's shortly talk about an index. An index is a preset collection of stocks, bonds, or other assets. Some of the most well-known are S&P 500, which includes stocks of about 500 of the largest American companies. Then you have Dow Jones Industrial Average. This is an index that holds only 30 companies. However, those 30 companies are leaders in their respective industry. Then you have something like a Nasdaq 100 index. This index includes about 100 of the largest tech companies listed on the Nasdaq exchange. Now, there are also index funds. Those are very similar to an ETF with minor differences, and those are: an index fund is traded only once per day after market close. An ETF can be traded just like any other stock during normal market hours. Also, index funds usually have a minimum entry amount, for example, $3,000. ETFs can be bought with a much lower budget. Basically, as long as you have enough money to buy one single stock of that ETF, you can invest in that ETF. And to have a complete picture, there are also mutual funds. Mutual funds are actively managed funds that attempt to outperform a benchmark index. They come with a human factor and also with high fees. Now, let's compare index funds or ETFs to mutual funds. As we said, the objective of an index fund or an exchange-traded fund is to match the investment returns of a benchmark stock market index by merely mimicking the assets in that index. Mutual fund attempts to beat the investment returns of a related benchmark index. They all invest in the same things, such as stock, bonds, currencies, and other securities. Their management style for the ETF or index funds is passive. Investment mix is automated to match the exact holdings of the benchmark index. And on the mutual fund side, it's actively managed. There are stock pickers, so fund managers and analysts, that choose the fund's holdings. Another major difference is the management fee. For an index fund or an ETF is around 0.05%, and for a mutual fund is in average 1.35%. In case you wonder where I got the average for the mutual fund, here is a cutout from Investopedia, which says that an average expense ratio is between 1.25 and 1.4%. Then why invest in the ETFs? Well, don't take it from me, take it from Warren Buffett. Here's a cutout from the Wikipedia page of Warren Buffett, and it reads: Buffett has been a supporter of index funds for people who are either not interested in managing their own money or don't have the time. Buffett is skeptical that active management can outperform the market in the long run, and has advised both individual and institutional investors to move their money to a low-cost index fund that tracks broad, diversified stock market indices. Buffett said in one of his letters to shareholders that when trillions of dollars are managed by Wall Streeters, it will usually be the managers who reap the outsized profits, not the clients. The next part is also very interesting. In 2007, Buffett made a bet with numerous managers that a simple S&P 500 index fund will outperform hedge funds that charge exorbitant fees. By 2017, the index fund was outperforming every hedge fund that made a bet against Buffett. So there you have it. Now let's look at an index and different sectors of that index. If we look at, for example, an S&P 500 index, we will look at the sectors within that index, the percentage of each sector within that index, and some of the biggest companies. First one is the information technology with 27.5%, and in that sector there are companies such as Meta, Apple, Microsoft, Alphabet, and so on. Next sector is the healthcare, and it's about 14.5% of the index. Companies in the healthcare sector are Johnson & Johnson, United Health Group, Pfizer, and so on. Next one is consumer discretionary. This is about 11.2%. Companies in this sector are Starbucks, Home Depot, Nike, and so on. Then we have communication services, also around 11%. That's Comcast, AT&T, and so on. Then we have financial sector. That's also around 10%. Those are your Visas, the JP Morgan Chases, Bank of America, and so on. Then we have industrials with 7.9%. Those are 3M, Delta Airlines, Honeywell, and so on. Then we have consumer staples with 7%. That's Coca-Cola, Procter & Gamble, Costco, and so on. Then we have utilities with 3.1%. That's AES, UGI, Central Point Energy, and so on. Then we have real estate with 2.8%. Digital Realty, American Tower, and so on. Materials with 2.6%, DuPont, Sherwin-Williams, and lastly, energy sector with 2.5%, where you have companies such as ExxonMobil, Chevron, Halliburton, and so on. Now, let's build an ETF portfolio. The first thing that you need to do when building in your ETF portfolio is think about what your investment strategy is. For example, what is the index that you like, whether it's an S&P 500, a NASDAQ, a Dow Jones, a Russell 2000, or you can think about the sectors within the S&P, for example, or any other index. You can also think about specific industries like semiconductors or automotive, oil and gas, and so on. Once you know what you want to invest in, the second step is to research the ETFs that you're interested in and especially pay attention to the size of the ETF or the asset under management, historical performance of the ETF or the index, the composition of the ETF or the index. For example, S&P 500 is a market cap weighted index, which means that top 10 companies make up for, now I'm pulling numbers out of thin air, but I would say about 30% of the index without checking the data. Then you need to look at the expense ratios or the fees and so on. Now let's look at an example. Let's say we have $1,000 and we want to invest into healthcare, utilities, and the NASDAQ Next Generation. NASDAQ Next Generation, for those of you who do not know it, it's the next 100 companies after the NASDAQ 100. Just for the purpose of this example, I have found some ETFs from Invesco and iShares. You can see the amount of each holding. If we look at a pie chart, the investment will look something like this. Now, let's say 6 months or a year go by and your ETF portfolio now looks like this. You have had some gains in the NASDAQ Next Generation as well as the healthcare sector. However, the utility sector has gone down. This would be a great opportunity to rebalance so that you are again within the initial allocation of your funds. Here you can see that after rebalancing, we have reduced NASDAQ Next Generation and healthcare and increased our utilities. So it looks like we had it at the beginning. Now, let's get to my thoughts. In my opinion, ETFs are a great way to invest if you are not interested to be a stock picker and if you do not want to actively manage and closely follow your stocks. Also, if your risk tolerance is not high, ETFs provide enough diversity and therefore enough exposure and protection. So investing in single stocks is relatively risky because the average stock price varies up to 50% up and down within the year from the current price. And that makes them much more volatile than a bundle of 500 or 300 or 100 stocks. If you're not interested in investing in ETFs, there are also some alternatives for you. Those alternatives are, for example, mutual funds. However, funds that outperform the broad market index are few and far between. The average return of an S&P 500 index, you can see on the picture to the right that over the last 10 years, it was 14.8%. Over the last 30 years, it was 9.9%. And over the 50 years, it's 9.4%. So it's very important to set your expectations right. Here's also a cutout from an article from CNBC from March 27 this year, where that says, new report find that almost 80% of active fund managers are falling behind major indexes. I would think it's indices, but what do I know? English is not my first language. Another alternative to ETFs is taking matters into your own hands. Basically, do not listen to your investment bankers. They are in the game for it themselves. Also, there is no need for a permanent financial advisor that you have to pay that manages your money. If you need a financial advice, go to a financial advisor, take a couple of hours, go over your investments with him and pay him for his time. After that, you should be again on your own. Invest in yourself, learn about investing, learn about managing money. It is not rocket science. Create your own investment strategy tailored to you. There is no need to overcomplicate it. Just keep a long-term mindset and dollar cost average, baby. Here are some websites that I use when researching ETFs. As I live in Europe, for me, it is just ETF.com and extraetf.com. Those are the two websites I use. If you find value in this video, I kindly ask you to like this video, subscribe to the channel and share it with your friends. This helps me a lot when you guys do it and it does not cost you anything. No need to smash any button, just click it gently and I will be happy. And now, you tell me, what do you think about investing in ETFs in general? Do you also invest in single stocks? Give me a feedback, I would love to hear from you. That's it for now. Thank you so much for watching. I hope you enjoyed it and I'll see you in my next video.